Welcome to Stock Talk with Nico Kritikos. Today we are going to do some stock analysis for Planet Fitness, ticker PLNT. This is because the stock has fallen over 15% today, falling from $59 a share this morning all the way down to $50 a share right now. And it seems like the only reason this is because their CEO got kicked out pretty much by the board of directors, and they're going to get a new CEO. And it's kind of like there's not really a strong reasoning out there for this. So it's kind of up in the air at the moment, but we will see what happens. So Planet Fitness, this year it was trading mostly around this, $70 to $80 range for most of the time. The last 5 years, it's been trading anywhere from $55 all the way up to $100 a share. So this $50 price point is actually pretty attractive from that standpoint because it hasn't been this cheap since summer of 2020. So we're going on over 3 years now since we've seen these prices, and I'm a little bit interested. So let's look at, for one, I guess we can start with let's start with the Google trend. So here's Google Trends for the last 5 years of Planet Fitness. Not a ton of changing here. It's pretty much been similar search volume the whole time. So, but I always like to just check that just to make sure to see if people are searching for it. The next thing would be some of their competitors and how much are there other gyms that charge their prices, because although there's a couple other gyms like UFit gyms and Crunch Fitness. The difference though is that Planet Fitness has tons and tons more locations than these other competitors do. So they're really the only ones who are mainstream charging $10 a month, because these other ones only have 80 locations or a couple hundred, whereas Planet Fitness has over 2,400 at this point. So that's something to keep in mind. Then on their investor presentation, there's a ton of different stuff in here, but one thing that stood out was just from 2003 to pretty much the last 20 years, all the different milestones they hit as far as how many stores they're opening, as far as how many members. It looks like they have over 17 million members now. So that's just some good information to know. Now, if we start with I guess we can look at their insider trading as well. This was the CEO that I don't know if he really left or if he got kicked out more so, but as of 3 months ago, he bought 10,000 shares at $65 a share. And now it's $50 a share. So it's quite a discount compared to where he was buying, and he bought $650,000 worth. So that's something to not make your entire investing decision based off of, but definitely take into consideration. Revenue trend, we're looking at an average of 17% growth. However, this year and next year, it's expected to only be 11%. So it's definitely starting to slow down. And as you can see here, they did $936 million of revenue last year. And then over the last decade, we pretty much have had consistent growth. The last 5 years, though, is averaging 17% growth. However, really, if you think about it, the pandemic years that threw off those numbers because nobody was going to the gym, their growth probably would have been stronger if it wasn't for those events taking place. So really, like the last 2 years, it's up 50 or 60%. We might see them return back to, over 20 or 30% revenue growth on an annual basis, but we will keep an eye out for that. Then we get to net income. I'm also going to give this one a check. They did $100 million in net income last year. And keep in mind, this is a not 5.2. It was a $5.2 billion company. But now, see, this morning it was $5.2 billion. But now it's only a $4.4 billion company. So the valuation is coming down quite a bit. But it's good to keep in mind that they're doing $100 million in net income. And again, how I said, of course, 2020, they lost money. 2021, it slowly was improving. And then now they're kind of back to where they were previously. So about $100 million. Although they did slightly over $100 million in 2019. And so I would actually, once you see the next metric where we're looking at the PE ratio, this stock sure has been trading very expensive. And not only that, but there's not much consistency on where it trades, because it seems like it's always moving and it's jumping around from back here it traded at 80, 70, 60, 50, 40, and then in the last couple of years it was trading as high as 200 times earnings, 250 times earnings, and now we're all the way back down to 40. But really, it hasn't stopped falling. So I'm kind of wondering if it's going to keep falling, and maybe it comes down to 30 or 20 times earnings. Who knows? So that's something to think about. But I would really justify, 40 or 50 times earnings only if it was growing at a giant, 25% or 35% per year. That's what I would like to see. But with that being said, we're looking at 31 times trailing earnings right now, and then based off of this year's earnings, if they do $2.18 of EPS, we're looking at about 23 times forward price to earnings, which is way cheaper than where it normally trades. Right now, it is looking like it's starting to. It's really hard to say because every couple months it seems to get a lower and lower valuation. I don't know if that's just because growth is slowing down or what's the main cause of that, but it definitely is coming down quite a bit. Then we're going to go to the innovation. I would say yes, just because they are implementing digital strategies, as well as their reputation and their prices kind of have them famous for being a no judgment zone, as well as, again, the $10 a month pricing model. So those are a couple things that they are, I guess you could say, advantages for them. Strong market share, not really. This whole space, I believe, is worth about $30 billion as far as gyms and health clubs. And there's so many different competitors. But with them getting 1 to 3%, that's not bad. There's so many different gyms out there. 1 to 3% is not horrible. And if they can keep up the growth, maybe they can get to 5% and on. Return on invested capital, I put no just because it's under 10%. They're only doing about 8%, which is not great. Their equity is improving. However, we have a problem here because it's negative. And it was negative 700 million a couple of years ago, and now we're looking at negative 215 million. So that's not good at all. That's really bad. But it definitely is improving. So I gave that a check. But as for the equity being 15% of the market cap, not even close because it's negative. And then the share count decrease, this one is also going to be a no. This one's not a big deal because it's only a couple percent, 1 or 2%. So that's nothing to worry about. Assets minus liability, or assets minus goodwill, is definitely not 2x liabilities. Profit margin of, I think it's just 10%, so it's not outstanding but good enough. Cash and receivables, we're looking at, I believe, about $400 million of cash and receivables, and they're doing $100 million of net income, so that'll get a check. No dividend, it's over 10 years old, and the free cash flow, I put yes. It's growing at an average of about 8% per year. As you can see here, this is actually the stock-based compensation adjusted free cash flow chart. But last year they did 132 million of adjusted free cash flow, with the regular cash flow being 140 million. So the share dilution is bringing it down just a little bit. So overall, I'm kind of interested in this. The only thing I'm really not happy about is the equity. I wish the equity was positive, which it looks like it's only negative 200 million. So maybe they can turn things around within a year or so, maybe 1 to 2 years. But other than that, the price is really cheap for this, considering this stock traded as high as $100 and normally it's trading around $70. $50 is a pretty good deal. And I'm going to keep an eye on this one. Normally, what I've noticed is that when stocks have a giant drop like this in one day, a 15, 16% drop, it doesn't normally bounce right back up the next day or even a couple days. It normally takes a couple of weeks, even up to a couple months, to start going on a run again. And really, you need some good news to come out, or you need an analyst to come out and raise the price target on it. One of those things needs to happen in order to, because Planet Fitness also just reported a good earnings report too, I believe. I don't know what it is, but I'm pretty sure they reported a good earnings report. So one of those things need to happen in order for the stock to go back on a run. So I'm in no rush, even though the stock is historically trading cheaper, and this is a well-known brand with a ton of locations and a good business model. I'm not really a fan of the gym, but I can see as a business proposition how it's attractive just because it's only $10 a month. So they're going to get lots of people to sign up. So I understand that. But even with the valuation being cheap, I would like to see positive equity. And then I'm not going to jump on this right away because there's a good chance it'll take some time before the stock goes on a run again. So that is my analysis for Planet Fitness. I will see you in the next video.